Why does a billionaire CEO like Elon Musk often take a salary of exactly $0 year after year? And why do the ultra-wealthy aggressively utilize debt while the rest of the world is terrified of it? It is because they are playing a completely different game with a completely different rulebook than the working class. If you earn money from a job, pay taxes, and then save what is left, you are mathematically guaranteed to lose the wealth game. But there is a backdoor in the financial system that allows you to pay effectively 0% tax while maintaining total control. This strategy is called buy, borrow, die, and by the end of this video, I will show you exactly how to build this engine. I am Mugada Siva Ganesh, and today we are going to decode the financial operating system of the top 0.01%. Most people operate under the false belief that the path to wealth is to get a high-paying job and simply increase their earned income. But income is actually a financial trap, because it is the most heavily taxed, least efficient form of money on the planet. In the United States, high earners can lose up to 50% of their capital to the government before it ever hits their bank account. This is why the ultra-wealthy avoid income entirely and focus their efforts on acquiring and holding assets. I believe debt is the wonderful way to take leverage of capitalism and inflation to accelerate wealth. Everything in our current economic system favors the borrower if used correctly for growth, without selling compounding assets. To understand this, you have to realize that the tax code was not written for workers. It was written by owners for owners. When you work a job, you trade your time for cash, and the government takes its cut immediately. When you own an asset, like a business or a stock portfolio, you pay absolutely nothing on the appreciation until you sell. This is called an unrealized gain, and it is the mechanism that makes the buy, borrow, die strategy possible. Imagine you bought a house for $100,000, and 20 years later, it is worth $1 million. You are $900,000 richer on paper, but the IRS cannot tax you a single cent on that growth. The value is locked inside the asset, growing tax-free, year after year, compounding in silence. But the moment you sell that house to get the cash, you trigger a massive taxable event. You stop the compounding, you pay the government, and you reset your wealth-building journey back to square one. The ultra-wealthy never sell. They know that selling is the ultimate enemy of wealth accumulation. Instead, they use a three-step system to access their wealth without ever triggering a tax bill. Step 1 is buy. Step 2 is borrow. And step 3, as morbid as it sounds, is die. Let's break down exactly how you can start building this machine today, even if you are not a billionaire. The first phase is buy, but we need to be very specific about what we are buying. We are not buying liabilities like cars or gadgets that lose value the second you drive them off the lot. We are buying appreciating assets that compound over time and possess high collateral value. For a strategy like buy, borrow, die, there are two primary asset classes that work best: stocks and real estate. Real estate is the classic example used by most people because it is stable and banks love to lend against it. You buy a property, it goes up in value, and you have a tangible physical asset that produces rent. However, as a trader and investor, I prefer the liquidity and speed of the financial markets. I focus on acquiring shares in high-quality businesses that have a potential for long-term growth. When you buy a stock, you are buying a piece of a living business that is working 24 hours a day. The goal in this phase is accumulation. You channel every spare dollar into these assets. You do not trade in and out of them for short-term profit, because remember, selling triggers taxes. If your portfolio grows from $100,000 to $500,000, you have $400,000 of unrealized gain. To the IRS, you are broke because you haven't realized any income. But to a bank, you are a prime client. This accumulation phase takes time. It requires discipline. It requires you to live below your means while you build your fortress. But simply buying assets is the easy part. The real danger comes when you try to execute the second phase, borrowing. If you borrow at the wrong time, or with the wrong terms, you can lose everything you have built. The difference between leverage that makes you rich and leverage that makes you bankrupt comes down to one single variable. That variable is the cost of money, also known as interest rates. If you don't understand how interest rates affect asset prices, you are driving a race car blindfolded. However, buying assets blindly is not a strategy. It is gambling. Before you apply leverage, you must be able to value the asset correctly. If you cannot read the economic signals, inflation, interest rates, and earnings, you will buy at the top and get wiped out. This is exactly why I wrote my book, How to Read the Market. It is a step-by-step guide to analyzing financial news, understanding economic indicators, and making confident investment decisions without relying on luck. It turns the chaos of the market into a clear, actionable checklist. Stop guessing and start operating with precision. You can view it on Amazon by scanning the QR code on your screen now or by clicking the link in the description. Now that you have the manual, let's enter the machine and see how the borrowing phase actually works. Phase 2 is borrow. This is where the magic happens and where the tax system is legally bypassed. The core concept is simple. Borrowed money is not income, it is debt, and debt is tax-free. Let's use a concrete example. Imagine you have built a portfolio of stocks worth $1 million. You want $100,000 to buy a luxury car. If you sell your stocks, you trigger capital gains tax. Depending on where you live, that tax bill could be $20,000 or more. That is $20,000 gone forever. Instead, you go to your brokerage and ask for a securities-based line of credit, or SBLOC. This is a revolving line of credit secured by your portfolio. It allows you to borrow cash without selling a single share. You take out the $100,000. You pay zero tax because the IRS does not tax loans. Your stocks stay in the market. They continue to grow. They continue to pay dividends. But wait, you say, isn't there interest? Yes, there is, but the math is heavily in your favor. Let's say the interest rate on the loan is 5%. That costs you $5,000 a year. Compare that to the $20,000 tax bill you would have paid upfront if you sold. You are saving $15,000 immediately. Plus, your $1 million portfolio is still working for you. If your portfolio grows at just 7%, you earn $70,000 that year, easily covering the interest cost. This is arbitrage. You are earning a higher return on your assets than the cost of your debt. However, this is where the danger lies. This strategy requires strict risk management, specifically regarding loan-to-value ratios. Loan-to-value, or LTV, is the percentage of your portfolio that you have borrowed. If you have $1 million and borrow $100,000, your LTV is 10%. This is safe. If the market crashes by 50%, you still have plenty of equity. You won't get a margin call. But if you borrow $500,000, your LTV is 50%. This is suicide. A market drop will force the bank to sell your stocks at the bottom to cover their loan. You lose everything. The rule of the ultra-wealthy is simple. Borrow against your assets, but keep your LTV low, typically under 20%. This buffer allows you to weather any storm, sleep soundly at night, and never be forced to sell at the wrong time. But there is an obvious barrier to entry with the stock market strategy that most financial gurus conveniently forget to mention. If you walk into a bank with a $5,000 stock portfolio and ask for a low-interest line of credit, they will show you the door. The securities-based line of credit strategy usually requires a minimum of $100,000, and often millions, to get attractive rates. This gatekeeping forces the average investor to change the vehicle. You must use the one asset class where debt is democratized. That vehicle is real estate. This is the only asset class where a bank will happily lend you hundreds of thousands of dollars. Now that you have the manual, let's look at the mechanics of the cash-out refinance. Let's say you buy a rental property for $300,000. Over 10 years, it appreciates to $500,000. You have $200,000 of equity sitting there. If you sell the house to get that money, you trade your taxes and fees. You walk away with less than half of your profit. That is wealth destruction. Instead, you go to the bank and execute a cash-out refinance. You take out a new loan for 75% of the new value. You pay off your old loan, and the difference, let's say $150,000, is deposited directly into your checking account. Is that $150,000 taxable income? No. It is debt. It is tax-free cash. But here is why real estate is structurally safer than stocks for this strategy. The 30-year fixed-rate mortgage. With stocks, if the market crashes, the bank can call your loan tomorrow. With real estate, as long as you pay the monthly mortgage, the bank cannot touch you. The bank doesn't care if the house value drops next year. They can't force you to pay the loan back early. So you have the tax-free cash. Now what do you do with it? This step distinguishes the wealthy from the indebted. Amateurs take that borrowed money and buy a boat or a car. That is consumer debt, and it is financial suicide. The professionals take that tax-free cash and use it as a down payment for the next asset. This is the velocity of money. You are using the same initial dollars to buy asset 1, borrow against it, and buy asset 2. You are building a massive empire of assets, controlling millions of dollars of property, while legally showing very little income on your tax return. But isn't all this debt dangerous? What about the interest payments? This brings us back to the philosophy I stated at the beginning. Capitalism favors the borrower. Inflation destroys the value of cash, but it also destroys the value of debt. If you borrow $1 million today, in 20 years, due to inflation, that debt will be worth significantly less in real purchasing power. You are paying back the bank with cheaper inflated dollars in the future. The bank is effectively subsidizing your wealth building. This is why the rich stay rich. They own assets that inflate with the economy, while their debt gets inflated away into nothingness. So we have bought, we have borrowed, we have lived a life of luxury using tax-free liquidity. Now comes the final, inevitable step. Phase 3, die. Eventually the game ends. You pass away. And this is where the IRS usually waits for its final, massive payday. But for those who hold assets until death, there is one final miracle in the US tax code, called the step-up in basis. Under current tax law, which is subject to future legislation, this allows the entire tax liability to be wiped clean. Let's go back to our stock portfolio example. You bought it for $100,000. It grew to $10 million over your lifetime. If you sold it the day before you died, you would owe millions in capital gains tax on that $9.9 million profit. But if you hold it until you die, the cost basis of those assets is stepped up to their market value on the day of your death. Your heirs inherit the stock at a value of $10 million. If they sell it the next day for $10 million, their taxable gain is zero. Decades of appreciation, millions of dollars of growth, zero tax paid by you, zero tax paid by your heirs. The tax liability didn't just get deferred, it got deleted. It vanished into thin air. But wait, what about the debt? You borrowed millions against these assets to fund your lifestyle. That debt doesn't just disappear. Correct. The banks still want their money. This is where the final piece of the puzzle comes in. Life insurance. The wealthy often hold massive life insurance policies inside an irrevocable life insurance trust. When they die, the insurance payout, which is tax-free, is used to pay off the outstanding loans. The heirs receive the assets with the stepped-up basis, free and clear of debt, and the cycle begins anew. The buy, borrow, die strategy is an exponential curve. The end is fast and vertical. But the beginning? The beginning is the hardest part. The math of compounding dictates that the early phase is the slowest. This is the accumulation zone. In this phase, the goal is not lifestyle, it is liquidity. Every dollar spent on consumer goods is capital removed from the compounding engine. You must aggressively maximize active income to reach the lending threshold. Here is your roadmap. Step 1. Eliminate bad debt. You cannot build wealth paying 20% interest on a credit card. Step 2. Accumulate your first $100,000 in liquid assets or equity. This is the hardest money you will ever make. Step 3. Execute your first small borrowing experiment. Refinance a property or take a small margin loan to buy a safe asset. Test the mechanics. Feel the weight of the debt. Understand the monthly payments. Get comfortable with the leverage. And step 4. Scale up. As your assets grow, your borrowing power grows. The snowball begins to roll on its own. You stop trading your time for money. You start trading your creditworthiness for assets. You cross the divide from worker to owner. The system is indifferent to your feelings. It rewards those who understand the rules of debt and taxes, and it punishes those who do not. You now have the blueprint. If this deep dive into the mechanics of a global financial strategy sparked your interest, you will definitely want to watch the videos appearing on your screen now. They explore the hidden systems that drive our world and challenge the way you think about money. If you found this breakdown valuable, subscribe for more briefings on foundational finance. I'll see you in the next one.